Sandeep Parekh, we appreciate you taking time out for us. Thank you very much for joining us today. Okay, that's one view of the takeover code. Clearly a thumbs up for the changes brought out by the code. We now turn to a company that's on our radar, and some important announcements are expected from the company. Joining us now is Sunil Duggal, the CEO of DaburIndia. Mr. Duggal, I understand that you are going to make some important announcements on a Sri Lankan subsidiary.
No, we've just planning to set up a plant there, and we've signed the agreement with the Board of Industries of Sri Lanka. So the plant should go on stream around next August, September, and it's a fairly significant investment which will augment our capacity in the juices segment.
What exactly are the items you will produce over there, and will margins be much better in that location?
Yes, it would be. We would largely produce the real brand of our beverages, and subsequently we will even produce some of the cosmetic and toiletry items. But the plan for the next year is confined to beverages. The margins would be better because we could feed South India markets from Sri Lanka, which as against from Rajasthan and Nepal, where the current two plants are located. So obviously there would be supply chain upsides, particularly with regard to freight. So we would capture better margins out of Sri Lanka than we are currently doing so.
Sunil, just wanted to stay with the Sri Lankan space, and actually the entire international sales of Dabur, which according to reports is basically doing better than the domestic sales for the company. Take us through the strategy and what we could expect in terms of contribution from international sales vis-a-vis domestic.
Well, the international sales today are around 30% of total business, and they are, yes, going ahead of domestic, even though not by a very wide margin. Growth overseas is around 18-20%, excluding the acquisitions, as against 13-14% in the domestic space. So that's a pattern which we've seen over the last few years, and that continues, even though overseas growth has come down a little bit this year against what we did in the last couple of years because of local political uncertainties in the Middle East. So going forward, we would see overseas sales inching ahead of domestic in terms of growth, but the dominant portion would still be domestic sales. So I think the ratio would be around 2/3, 1/3 in favor of domestic over the next 3 to 5 years. But if there were other acquisitions which may or may not happen, then the ratio could be skewed definitely quite differently.
Sunil, let's speak about margins. We are sitting on the throes of a fairly decent monsoon. Have you noticed any fall in your raw material prices? And what are your plans with respect to passing on prices which you perhaps couldn't do in the first quarter?
Well, there is some visibility in terms of softening of commodity prices, the impact of which will be felt towards the middle and the latter part of the year. I think some upside we would start capturing in the third quarter. But the second quarter probably has been the worst in terms of inflationary impact. We've been sitting on very high priced raw materials. So the numbers obviously would be impacted by that fact. But having said that, the outlook seems, like I said earlier, to be much more benign.
Okay. Mr. Duggal, we'll have to leave it at that. Thank you very much for joining us. The Reliance Communications AGM has begun, and we have to listen in to what the management has said.
We move on to our second customer, very different from Sylvie, lives in Bombay, is a financial analyst.